predicting terrible, terrible outcomes. So when this happens, I would say, well, how well has he been able to do in the past? So there's this book, The Real Crash Ahead, How to Save Yourself and Your Country. And he says this in the book. When this is specifically targeting just his investment advice. He says, and this is a direct quote, "The central problem is this. What was previously safe may no longer be safe. The U.S. Treasury is the next bubble to burst." He says, "I've been giving my clients the same advice for 10 years. Some of it happened more quickly than I expected. Some of it happened more slowly." And see, that's the problem with economic forecast. If you're trying to forecast what's going to happen next, and if investors should be in or out of gold, in or out of cash, in or out of foreign equities, in and out of the U.S. market, then you have to be right 100% of the time. One mistake can cause massive devastation. He goes on and says, you can sense the underlying fallacy here, the belief that stocks always go up. One reason I advise clients to buy foreign stocks is that they are more likely to pay dividends and higher dividends as well. Now, that is a correct statement. Foreign stocks do tend to pay higher dividends. In other words, he says, Americans can only live beyond their means because a good portion of the rest of the world is willing to live beneath its means. This is kind of almost like a colonialism kind of argument that, that we're really, the other thing here that really gets me is, hello, Peter, other countries are living beyond their means too. Have you heard of Greece, Portugal, Spain, Italy, little countries? How about France? Hey, he thinks we're in a bad position. Look at these other countries. They're 20, 30 years of socialism beyond where we are right now. So this doesn't really make a lot of sense to me. So here are a few of the countries I like and a few reasons why I like them, says Peter Schiff. He likes Australia, Singapore, Hong Kong, New Zealand, Switzerland, Norway, the Netherlands, Canada, and China. So instead of stock picking, he's country picking here. Any investment portfolio needs to be balanced. That we can agree on. Yes, Peter, an investment portfolio needs to be balanced. And he likens it in his book to a stool with 3 legs.
Strong legs.
3 strong legs. You only need 3 strong legs to be diversified. So this will be interesting to go on to see what he says, how you're going to do this. So here are the 3 legs of the stool. Quality dividend-paying foreign stocks in the right sectors. Ooh. Don't be in the wrong sectors. Could be a mistake. Liquidity and less volatile investments such as cash, but he doesn't really like cash that much, and foreign bonds. So what are we going to have in our portfolio? Foreign stocks, foreign bonds, and of course we're going to round that out with a great diversifier, gold and gold mining stocks. Now, we don't really think that's very well diversified. As a matter of fact, we believe you need over 11,000 stocks in over 45 different countries. And to the extent that you're worried about volatility in the market, you don't buy gold. No, that would be a mistake. You buy short-term fixed income, which he hates, and you then manage your risk relative to the portfolio. The other thing that you do is you ask yourself some questions like, what amount of standard deviation am I really able to stand? What's my long-term expected return on the mix of my portfolio? Where do equity returns really come from? So let's break this apart one by one. His comments on leg number 1 of the stool on dividend stocks. He says this, remember, the best reason to buy stocks is not simply because you think they'll go up. That's speculation, my friends. But because they pay dividends. In fact, he goes further in his book, and this is a direct quote from the book, if there are no dividends in the future, this looks like a Ponzi scheme. Dan, you want to comment on the Ponzi scheme? So I guess we shouldn't buy any stocks that ever don't pay dividends. Obviously, if we don't, that's just a Ponzi scheme. I know you came up with a couple of stocks that we don't think are exactly are Ponzi schemes.
Yeah, I think Apple, granted Apple did just pay its first dividend, but Apple I think is the largest capitalized company in the world right now, and it started up from some guy's name by the name of Steve Jobs' garage. So and on the other side of the coin, with dividend-paying stocks, you have companies like GM, paid dividends until they went
Yeah. Yeah, but it's not a Ponzi scheme if you do dividends. I mean, what's interesting is that, you know, the idea that a stock has to pay dividends or it's a Ponzi scheme is absolutely ridiculous. There are a lot of great companies that don't pay dividends because they have great business ideas and they're reinvesting into their business. They're not paying dividends. People aren't buying them because they're trying to speculate over the next 10 minutes. But many people own them over 10, 20, 30 years because they know that the cost of capital for companies is high. See, it's a really cost of capital story. But the problem with Peter, even though he believes in free markets when it comes to the country, when it comes to capitalism, he doesn't believe in free markets when it comes to investing. What I mean by that is he believes that prices are set best by consumers in a sense for companies, their products and services, but he doesn't believe that when it comes to their stocks. He believes the free market gets it wrong. But Peter, supply and demand. You have willing buyers and willing sellers with all knowable and predictable information in the price today, and the price set by those individuals is the best price for the future. So the idea that I know you hate centralized planners on a global political scale, you are a centralized planner when it comes to a portfolio. You, in essence, are saying that all stocks that don't pay dividends are mispriced because they're too high, and stocks that pay a dividend are lower than they should be because they have higher expected long-term returns. As a matter of fact, everybody knows they pay dividends, and the day a dividend is paid, the stock price goes down by the equal amount. That's a net zero return. So it has nothing to do with how many dividends the stocks pay. It has all to do with the cost of capital of the company. Stock market returns come from variability and randomness in the market. So large stocks have a 9% premium long term, microcap stocks have an additional 2 to 3% premium, and small value companies have an additional 3 to 4% premium based on the cost of capital because, Peter, markets do work. So why do you believe that markets work when it comes to capitalism in businesses, but you don't believe markets work when it comes to pricing stocks? It's just not consistent. Peter, you're better than this. Let's go on. He says, they are buying these stocks in the expectation that someone will be willing to pay a higher price later on. Not really. Yeah, if you're a day trader getting in and out on a daily basis, that would be true. But if you're a long-term investor, you own equities because you understand they are a 30-year hold. He calls it the greater fool theory. So let me get this straight. If you buy any stock that doesn't pay a dividend, you are in essence a fool searching for a greater fool somewhere down the line. Really?
Sounds like gold.
Sounds like gold. They are buying these stocks in the expectation that someone will be willing to pay a higher price later.
Greater fool is someone with the perfect blend.